we believe we're fighting the good fight, part of the freedom in America moving forward. And it's part of the $84 trillion transfer of wealth, Brett, that's moving from our parents to us in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. And we think it's a good fight for freedom because if the government gets the money, guess where our freedoms go? They go lower. Why? Because they're inefficient with the capital, and there's a lot of other deals that they're making for themselves and, let's say, their constituents. But if we keep the wealth in the hands of the people who created it and invest it back into the communities that make sense and hold people accountable for, we do think we can start to solve the housing crisis. There's over 4 million units that are short across America. And so if money can be poured back into multifamily developments, into single family home developments, fix and flip opportunities to improve communities, we believe that can transform one of the biggest crises, which is the housing crisis.
What's going on? This is the Indie Investor Podcast. Brett Snodgrass here, and I'm with Brett Swarts. What's going on, Brett?
Hey, Brett. It's going really well. First thing is you spelled your name correctly, 2 T's. I want to thank your parents for spelling it correctly, not with 1 T.
That's right. Yeah, man. So you too. So welcome to the show.
Thank you.
I love your name, by the way.
Thank you, sir.
Guys, Brett Swarts is, number one, he's a deferred sales trust trustee, and he's really an expert with capital gains tax deferral plans, has a book out there called Building a Capital Gains Tax Exit Plan. But he's way more than that. He's going to talk to us today about how do you defer capital gains taxes. We all want to save on taxes, right, Brett? I mean, isn't that something we're always trying to get better at? We never can quite get there, but every year, when especially around this time, how do I save money on taxes? So take us into kind of like maybe high level. What do you do? And take us, that's kind of what you do, defer capital gains taxes. But what do you really do, man?
Yeah, we help people have a really tax flow mindset versus just a cash flow mindset. Most of us have been taught it's all about cash flow. Cash flow is king. And yes, there's truth to that. And yes, that's very true. But just as more importantly, tax flow is, I think, now becoming the new king, because guess what? The government has a spending problem, Brett, and it's somewhere around $32 trillion, which means you, me, and the listeners have a tax problem.
Yeah.
And to the extent that we're not having a tax flow mindset and are just focusing on cash flow is where we're actually going to have a lot of our wealth depleted. And I was just at a big real estate conference, and the gentleman who's, I think, probably worth about $1 billion was talking about how he grew wealth in multifamily investing. And part of that, he did an analysis about the penny every day for 30 days. And, the saying goes, would you like to have $1 million today, Brett? Or would you like to have a penny double every single day at the end of 30 days? And you ask these to kids, and we got asked all the time. And we know this story now is you always wanted to have it double. But he said, have you ever run the analysis where you actually add the tax on that? And he used like a 28% tax, that every time before that penny went in, it was taxed at 28%. I had never thought of that before, but it's a great illustration. So the first thing is if you have $1 million today, that's the first option, or a penny that doubles, it's about 5.7 million in 30 days. Obviously, you'd rather have that one double. But do you have any idea, Brett? I'm curious what you think, what it would be if before that penny went in, it was taxed at 28% each time. What would it be at the end of 30 days?
Man, you were going to stump me big time. I'm humiliated on the show. Wow, 28%. I don't know. Would it be, I'm just going to say $1 million.
Way less than that. It'd actually be about $70,000. Now, my brain is still exploding from this because I go, wait, you're telling me you went from 1 penny to 5.7 million, but if it got taxed at 28% every time, it would be it's like $67,500 and something dollars. And so this is the world we're in. Like, and we don't necessarily realize it sometimes. It's sort of like that frog that's sitting in that's getting boiled in the water. We're getting taxed, a lot. And if you don't have a tax flow game and a tax flow mindset, especially when selling $1 million assets, right? Or businesses or cryptocurrency or stock, that's going to be wiped out by somewhere between 25 and 50% of your gain. That's the big problem we're trying to solve here. You're missing out on a big way to build wealth. Most people will show up to the investment, or if they're investing with you as a listener who's investing into multifamily properties or other assets in Indiana, right? You're looking at people showing up with capital post-tax. Now, sometimes you have a self-directed IRA or self-directed 401k, and there's some ways to get some tax efficiencies there. But what about the big exit for that primary home that's worth $5 million, or that big exit of that business that's worth $50 million? These are not 1031 exchange eligible, but you can defer capital gains tax using our strategy. And so we just help people focus on that, understand that, and see what's possible so everyone can preserve and create more wealth.
No, I love it, man. I love it. So you talk about this tax flow mindset. Can you take us that a little bit more? I mean, I think about taxes, but what should I be thinking about? Because I don't think about it a lot. Like I don't think about it as much when I'm thinking about cash flow or I think about flipping a property. I really just look at the number. Oh, I make this much money. That's great. But I feel like I'm lacking in that mindset, that tax flow mindset. Can you take us in? How do I get better at that mindset, the tax flow?
Well, I think the first thing would be, knowing that your tax flow is connected with your cash flow and vice versa. They're all, if this currency is flowing, right? And if you don't have a team and you don't have the strategies to make the currency of cash flow efficiently into your tax flow game, then you're leaking, right? You're leaking and you're paying a lot of tax. I'll just give you a couple of deal stories. So we work with commercial real estate operators that buy multifamily properties. And for the longest time as the GP, they would just sell and just everyone would pay their tax and they would all show up and come back together for the next deal. So we started with a $20 million asset of theirs. And they go, Brett, we do about 3 to 5 of these every year. One was 20, one was 16, one was 33, one was 48. And every time they were exiting their GP positions, they believed they weren't able to defer the tax because they were not going to do a 1031 exchange, right? They like to buy a property at 12 million and sell it for 20 like 3 to 5 years later, right?
Mm-hmm.
And they didn't necessarily want to go buy another big deal, or they couldn't find a deal. So the
Yeah.
point was
And
they were
there's all the
leaking on their.
restrictions with the 1031 too. It's
Yeah.
like, oh, you got to find it in such amount of time, and it's a lot of pressure. And what if you don't
Mhm.
find it? And yeah, a lot of paperwork there.
Exactly. So that's the first thing. So for them, we've done 5 exits over 120 million, but now theirs were just the GP smaller percentages. So that's the first thing. Like, it doesn't have to be $100 million deal or $50 million deal. Their positions were 750,000, 2 million, 1 million. I think another one was like 3.5 million. So these are small GP positions, not small, but I mean, in the consideration of like a 40 or 30 or $20 million deal, it wasn't necessarily huge, but it was substantial for their tax flow game because what did they do? Immediately they invested it back into other deals
Yeah.
that they otherwise would have to go get debt. And so we're so focused on working with lenders to get good debt, or we're so focused on raising capital over here from someone else, or to give up GP interest or LP interest, when a lot of it could have just been the excess that we could have deferred, right? That
Yeah.
we could have reinvested. So that's the first thing. The second thing is to understand depreciation schedules. So part of the reason to own cash flow producing assets is to have what's called depreciation to offset the cash flow. Now we're really familiar with this with like cost segregation or bonus depreciation or even just straight line. Now, if you're doing fix and flips, it wouldn't necessarily be applicable, right? Because you're doing it so quickly. But for those that are owning assets for 3, 4, 5 years, you're going to want to look at ways to depreciate so you can offset that cash flow. Well, guess what? There's a lot of assets that are not depreciable, like stock, cryptocurrency, or even businesses that are startup that have no depreciation schedule because they're just like, intellectual, mostly goodwill. So when you can exit that, defer the tax and put it into something that's not only cash flowing, but has depreciation, like a multifamily asset that's a 27.5 year depreciation schedule, of which you can do cost segregation, all of a sudden you're unlocking all of this extra, I guess, fuel, if you will. Think of it like you're in a sailboat, and this sailboat has a navigation system, and this navigation system needs to have an efficient way to get there, right? And if you don't have an efficient way to get there, you're going to be wasting a lot of the gas, a lot of the efficiency. And that's really the key thing is the tax flow mindset is how do I effectively and efficiently, and I don't even say be a good steward with your wealth, because taxes are the most expensive thing we're going to pay in our entire life, right? So how can I be a good steward with the wealth we've been either given and or we've helped create by working hard? And you've got to have that tax flow mindset. So hopefully that gives you the inspiration to start on that, Brett.
Yeah, no, I love that. So you have this book, Building a Capital Gains Tax Exit Plan, and you've mentioned a couple of people that are in multi-commercial, multifamily investments, selling high dollar commercial multifamily buildings. But what's your client? What's your normal client look like? Is it pretty much all real estate investors, or are these guys just selling businesses? And again, they have this huge gain and they're trying to figure it out. What's your normal client look like?
Yeah, it's 70% real estate, about 20% businesses, and then about 10% alternatives like a crypto or a stock type of exit or a primary home. So 70%. By the way, I say those big deals. We're doing, you know, $1, 3, $5 million deals. That's more of the bread and butter. Those other ones that were larger, their actual exits were more in that 1, 3, 5 million range of the net proceeds. Although the property was bigger, the asset was bigger. So there's debt in those, and there's other closing costs. So I would say, you know, real estate, especially primary homeowners that don't have a way to defer capital gains tax because it doesn't even qualify for 1031 exchange. Our strategy, the deferred sales trust, does. And then I would say business owners for sure, because they also don't have a 1031 exchange. So those are like prime. And we love the 1031s. We're brokers ourselves. But the challenge is most 1031s sometimes don't fit what the investor really wants. Either they're selling high and buying higher. Right now, we're seeing increased interest rates and cap rates that are pretty much, you know, maybe 50 basis points higher. A lot of sellers not willing to sell right now because they don't want to reinvest into something with a higher interest rate that maybe is a 1 or 2 points higher. So yeah, that's what I would say. Anyone that has $1 million net proceeds, $1 million gain qualifies for our service. You could also have a couple assets that work, you know, one at 800 and one at 300 to qualify. So it doesn't have to be just one, but it also works for short-term deals. So if people are churning deals, it has to be a big enough gain. We did 37 million in land sales for a seller who was tying up land under contract, and he would develop the land still under contract, and then he'd sell it like, you know, 6 months later to an investor, and he'd take the delta there. Now it was short term, didn't qualify because he hadn't owned it for 1 year. So the 1031 didn't qualify, but for us, we were able to solve that. So I guess there's just a number of ways we solve it. It just depends on everyone's circumstance, Brett.
Yeah, no, I love that. So take us through the process a little bit. So again, I have this asset I'm going to be selling. I have this large gain I'm going to be doing. You know, typically my mind again goes to, okay, man, I'm gonna have to pay. You've heard this all the time. I have to pay this large. I don't want to sell this asset because all the taxes I have to pay. So that's one way. That's one option. I can pay my taxes and just bite the bullet. You can do the 1031 exchange, but there's some different hiccups and some holes there. And so take us through your process. Like, so I'm going to make $1 million. I've owned this property for 3 years. I'm going to sell it. I'm going to make $1 million. What should I do?
Yeah, well, the first thing is could clarify what your vision is, right? So we say envision, build, freedom, or those are kind of the three kind of words there to start with. So first, I would say, Brett, what is your vision for your wealth plan, and what are the freedoms you're seeking, right? And what is the team that you need to build in between, and the strategies you need to build in between to help you to get to the freedoms that you want. And so your vision might be, you know what, I've got multiple kids and I've got multiple active income streams, and I'm looking to be a little more passive so that I have more time to spend with them and to travel more, to do those types of things. It could be you're looking to retire. Let's say you were in your 50s or 60s and you're like, you know, I'm still looking to retire from this big business. I've been pouring everything into it. And I just don't want to give away, 30 to 50% of the gain into tax. And I want to be able to live and travel and some time with family or give to the causes I believe in most, right? It just depends on what you're trying to unlock. It could be time, location, family time freedom. It could be, giving freedom. It could be 1031 freedom. It could be estate tax elimination. So first defining what you're trying to get to for freedom, and then defining obviously what the problem is. Do you have a big enough tax hit? Do you have any carry forward loss? Can you cost seg another deal to offset the gain on this deal? Can you actually find a 1031 that makes sense? By the way, we can be a backup for a failed 1031. So we're going to actually try to talk you out of this, figure out every which way that that you would not want to do it. And then, but oftentimes, again, if it's $1 million net proceeds, $1 million gain, we find it to be a home run for folks. That as long as you don't need to spend it all onto your primary home, spend it on your boat, because whatever you're going to spend personally will be taxed. But as long as you can invest it, and you can go and you can delay, I guess, gratification from taking that, you can defer the tax and you can grow your wealth.
Yeah, I love that. Can you take us a little bit more into where does the money go? Like, what? Take us through that a little bit. So these guys, they're listening. They might be like, okay, I'm interested. And can you take us through a little bit more of the process and where's the money go?
Yeah, we'd say the deferred sales trust is like Netflix and not Blockbuster is a good analogy here because it's so flexible. So the first thing is where's the money goes? It can go to a bank, it can go to TD Ameritrade, it can go to Charles Schwab. We use third-party financial advisors. We're not big on the stock market, but there is a time and a place to invest and diversify your wealth. A lot of our entrepreneur real estate clients really want to be able to get their cash liquid, diversified, and that's one of the advantages with the deferred sales trust is not only you're able to sell, diversify the wealth, but keep your powder dry. You don't have to do equal or greater value or equal or greater debt like the 1031. So if you had, let's say, you know, 10 houses that were worth, let's say, $3 million or so, right around there. Could you sell, defer the tax, and slowly consolidate your equity into one trust? Yeah, with multiple promissory notes. By the way, this is how it works. Anyone's wondering, you are lending money to a trust in exchange for a promissory note, and it's the net proceeds from the close of escrow that comes from the ultimate buyer. And essentially, this is able to keep you in a deferral state, but it helps you to consolidate that equity. And that equity can, again, sit at banks, can sit with the financial advisor until you're ready to strike on the next deal. That next deal may be tomorrow, maybe 6 months from now. It may be a couple of years. One of the best stories with the deferred sales trust was a gentleman who sold in the 2006, right around there, and then rebought the same property back foreclosed 5 years later using the trust as the joint venture partner.
Wow.
All tax deferred, not using a 1031 where you can sell high and buy low. So this is where it comes to where and how the funds can be invested. Some people put it in T-bills right now. You're putting it into 4 and 5% T-bills that are backed by the U.S. government. Some people are just putting in money market accounts. But a lot of people just think there's opportunities that are going to be coming here in 2023, and they want to be able to strike when the iron's hot.
Yeah. So this is awesome. So number one, so you really are an expert in capital gains tax deferral. In the exit plans, you wrote this book, again, Capital Gains Tax Exit Plan. Why would someone maybe want to work with your organization instead of really just talking about some of these strategies with their CPA and their accountant and going down that road?
A good question. So I think the first thing is typically if you're a real estate entrepreneur, if you are a business owner, entrepreneur, and you want that freedom and flexibility for someone who's been in your shoes, I would say we would be a great fit because that's where we started. We started out as Marcus and Millichap multifamily brokers, and we learned the struggles and the challenges when it came to making sense of connecting this tax flow world with the cash flow world, and especially real estate. So the big thing is a lot of times CPAs at your CPA, they're really good at showing or recording what happened the past year, but they're not great about strategy and connecting it all to real estate in ways that help you to not only preserve the wealth, but then create the wealth. And so our focus and expertise is within commercial real estate world, within brokerage, within investing, within development. So our background and our expertise is there. That should align. Now, more than that would be hopefully the value is aligned. Now, we believe we're fighting the good fight of really the part of the freedom in America moving forward. And it's part of the $84 trillion transfer of wealth, Brett, that's moving from our parents to us in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. And we think it's a good fight for freedom because if the government gets the money, right, guess where our freedoms go? They go lower. Why? Because they're inefficient with the capital, and there's a lot of other deals that they're making for themselves and and let's say their constituents, right? But if we keep the wealth in the hands of the people who created it and invest it back into the communities that make sense, that we can hold people accountable for, we do think we can start to solve what's called the housing crisis, right? There's over 4 million units that are short across America. And so if money can be poured back into multifamily developments, into single family home developments, and to fix and flip opportunities to improve communities, we believe that can transform some of one of the biggest crises, which is the housing crisis. The other one too would be the debt crisis. So the debt crisis is a big challenge, $32 trillion. Well, this $84 trillion, we believe we're never going to tax our way out of that. The only way is to grow our way out of that by creating more jobs, more tax revenue. And part of how you do that is you unlock the capital that's in crypto, that's in business ventures, that's part of the baby boomers that are transferring and selling out of their houses. and moving it into business investments such as multifamily, single family developments, and things that are going to create more jobs and more tax revenue. And that's the whole idea behind IRAs and 401ks and deferred sales trusts and 1031 exchanges is, hey, how as a government can we incentivize entrepreneurs to move their wealth, even opportunity zones, right? The whole idea was, hey, how do we incentivize people to take all this massive capital and redeploy it into communities, right, in a way that they can build wealth and it benefits the common good. And so that's the big picture. And so once you see that calling and what the opportunity is in front of us, people tend to want to join in that fight. And we welcome, new clients or new strategic alliances who are listening to this.
Yeah, no, I love that. I love that. I did a podcast one time on just how to pay zero in taxes. I think every real estate investor, this is who most of our audience is, right, should pay zero in taxes. And if you're paying any in taxes, then let's figure out different relationships like Brett that we can utilize to, again, just to keep our wealth, to pour back into our houses, pour back in our communities, and go from there. So, Brett, one last question. You have this book, Building a Capital Gains Tax Exit Plan. So any other things that you want to talk about as we wrap this show up is what's in the book? What can someone find out in the book? Why should they get it?
Yeah, so it's all about the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself and for your clients. So whether you're a commercial real estate operator, whether you're a real estate investor, whether you're a financial advisor, a CPA, a tax professional, it's great because it can help you help your clients unlock the freedoms they desire, particularly using the deferred sales trust as our niche focus. As well, if you're none of that, you're like, hey, I just want to learn. Well, there's an amazing person named Kevin Harrington from Shark Tank. He talks about being a mentor to millions and his journey of how he's making a difference with his brand, with his leadership, and with his impact. There's economists in here. I just have a couple chapters. They say to get in a room with smarter people, so I got in a book with some smarter people. So those would be the main reasons to check out the book, to read the book, to download the book. But I mean, if anything, if you're an investor and you want a way to save a failed 1031 exchange, this is the book because it's going to give you that backup plan in case it does fail. So yeah, check out Building a Capital Gains Tax Exit Plan.
Awesome. And that's a wrap. Thank you so much, Brett, for being on the podcast today. And also, guys, go check out Brett's website, capitalgainssolutions.com. Is that correct?
Capitalgainstaxsolutions.com.
It's capitalgainstaxsolutions.com. Check that out. If you're interested in, again, paying zero taxes, if you want an exit strategy and to save money, man, that's the way to go. So thanks a lot, Brett, for being on the show today.
Appreciate it. Thanks, Brett.